What's up, everybody? This is Sunko, the Korean bro, and today let's look at a stock article. Okay. Hmm. Okay. Let's see. Two stocks you'll be glad you bought at these prices. Mhm. Two top software stocks to buy for the long owl. Before you buy Irish Capital, here's a financial stock I'd buy first. History says the S&P 500 is headed higher in 2023. Two growth stocks to buy now, now, and hold forever. I'm just gonna go through every article that I can find, and then I'll be reading one by one afterwards. So prediction: two growth stocks will be worth $2 trillion by 2033. Uh, Google CEO Sundar Pichai predicts that this profession will be most revolutionized by AI. Hmm. Why I keep buying this 10% alien to imagine just made a big move nobody's talking about. Why I keep buying this 10% to a uh mm, okay. Now let's start. So two stars should be Airbnb's unique business model will continue to set it apart in the travel and tourism industry. Airbnb, okay. CRISPR Therapeutics' near-term outlook is quite favorable. Okay. Bear markets create opportunities to buy high-growth stocks at discounted valuations. Um, okay. This year, the stock market appears to be recovering. So far in 2023, S&P 500 is up 7%, a sharp turnaround from the 19.4% drop the market index recorded in 2022. Before their likely rebounds make them too expensive, here are two growth stocks to consider investing in now. And first is Airbnb. When compared to traditional hotel operators, vacation rental leader Airbnb stands out. Because of the unique experiences it provides travelers. Its online platform connects travelers with hosts who want to rent out their homes or other properties. In addition, it has an edge over its rivals because it allows travelers to rent even in unusual locations where most hotel chains don't choose to do business. Despite last year's high inflation, Airbnb mm, had a fantastic 2022. Its revenue increased by 40% to $8.4 billion, thanks to increased travel demand. With $1.9 billion in GAAP net income, it was also BNB's first profitable year. Its business model can be highly profitable as evidenced by its first quarter 2023 results. The company achieved its revenue guidance of $1.8 billion, a 21% increase year over year. GAAP net income of $117 million was up $136 million from the prior year period's $90 million net loss. The flexible and remote work culture that emerged during the pandemic appears to be still favored. With this in mind, in quarter four, Airbnb launched a new initiative called Airbnb Friendly Apartments to help long-term renters find apartments that they can part-time host on Airbnb. Management stated during the quarter first earnings call this concept is working well, with the number of buildings increasing from 175 in 30 U.S. markets in quarter four to 250 in quarter first. Based on this rapid growth, the company intends to quickly expand the concept to Europe, Latin America, and Asia. The company is financially secure enough to execute its growth plans. At the end of the quarter, it had $8.1 billion in cash and cash equivalent on the books. It also had $1.6 billion in free cash flow in 2022, a 33% increase from the year ago quarter. Yet with another strong quarter, the company demonstrated that its store is just getting started. The travel industry is also vulnerable to market risk. However, the rise in travel, even during last year's surge in inflation, shows that demand in this space is unlikely to disappear anytime soon. This year, the travel and tourism industry's revenue could reach $854 billion, according to Statista study. Given all that, this tech company's long-term prospects are exciting. Hmm. Airbnb. Hmm. Airbnb. Okay. Two top software stocks by for is a key software player in AI and cloud computing services. The trade buying platform is expanding during a tough economic time. Both of these companies have tapped into strong software trends. You don't want to miss out on what Microsoft and the Trade Desk are doing. Software stocks have caught the attention of some investors lately because some of the best software companies have been able to grow despite a difficult time for tech stocks in general. Two such companies are on track to remain great stocks for many more years to come are Microsoft and the Trade Desk. Both companies are investing in their futures by leaning into mega trends in their respective industries. Here's why their early leads could set these software stocks up well in the years ahead. Microsoft is injecting new vigor into its software apps as the company refocuses them on artificial intelligence. Over the past several months, Microsoft has said that it is infusing the ChatGPT chatbot into the Microsoft 365 suite of apps, the leading enterprise software in the world, to help its users become more productive and offload tasks. Microsoft has invested heavily in ChatGPT's owner, OpenAI, spending $13 billion so far, and it's betting that the eventual returns will pay off. The company's CFO, Ami Wood, said on Microsoft's recent earnings call, we will continue to invest in our cloud infrastructure, particularly AI related spend, as we scale with the growing demand driven by customer transformation, and we expect the resulting revenue to grow over time. The company is right to be optimistic about the possibilities of AI software, considering that our investment management estimate that the market could be worth $14 trillion by 2030. Microsoft is just getting started in this space. But with Word, Excel, Teams, and even its Bing search engine using the chatbot, the company is seen as a leader in the space right now. Hmm. It's also worth mentioning that Microsoft's number two spot in the public cloud computing space gives the company another large opportunity to benefit as more companies transition to cloud services in the coming years. Microsoft's strong position should help it benefit from the $463 billion by software as service market. The Trade Desk may not be a company you immediately think about when it comes to software stocks, but the company's ad buying platform has been a massive success as companies look for ways to buy and sell advertisements across internet connected devices such as smartphone and smart TVs. The trade ad sales jumped to 21% in the first quarter to $383 million, and the company swung from a loss of $15 million to net income of $9 million. The strong sales and bottom line growth are even more impressive when you consider that much of the advertising market is slowing down right now as companies try to figure out which direction the economy's headed. Meanwhile, the trade desk has maintained a customer retention rate of 95% for 9 straight years and continues to attract attention from large advertisers. For example, the company just added NBC Universal to the list of companies that are implementing the trade desk anonymous ad identifier UID2 across its ad platform. UID2 is a big step away from the lack of privacy that current trackers called cookies have, and the trade desk development of the new system has helped set itself apart as an innovative ad company. Investors who are worried that an economic slowdown could deliver a blow to the ad industry should keep in mind that the digital ad market is still on a long-term growth trajectory. Insider intelligence estimate that digital ad sales could reach roughly $836 billion in 2026, up from $627 billion this year. History says the S&P 500 could rise 20% in 2023, but the index is only up 7.4% year to date. Amazon is a leader in e-commerce and cloud computing. It's gaining market share in digital advertising. PayPal is a leader in online payment processing, and it's working to gain share in physical retail. Okay, let's read this one. PayPal reported solid financial results in the first quarter, a pleasant change of pace after a challenging 2022. Revenue increased 9.9% to $7 billion. 9% to $7 billion, and non-GAAP earnings rose 33% to $1.17 per diluted share. Both of those metrics represent sequential and year-over-year accelerations, and the particularly strong growth on the bottom line indicates that cost-cutting efforts are taking effect. Specifically, management has refocused its investment strategy on areas where the company enjoys a strong competitive edge: checkout solutions and digital wallets. Indeed, the investment thesis centers around those products. PayPal operates one of the largest payment networks in the world, with 433 million active accounts. Few companies ever achieve adoption on that scale, and PayPal owes much of its success to its two-sided payments network. Most payment processors work only with merchants, but PayPal provides financial services to merchants and consumers, and that gives it an edge. Specifically, PayPal has more insight into customer spending habits compared to many peers. It uses that data to drive sales and prevent fraud for its merchants. It does those things quite well. In fact, CEO Dan Schman says PayPal has the lowest loss rates, the highest approval rate in the industry. In turn, PayPal has become the most accepted digital wallet in North America and Europe, and the market leader in online payment processing software, according to Statista. Hmm. Here's the bottom line: PayPal is well positioned to benefit as digital payments become more prevalent, but the company isn't simply resting on its laurels. PayPal has continued to develop new products in an effort to reinforce its strong market presence. It recently launched the PayPal Complete Payments, an unbranded checkout solution that complements its Braintree platform. Braintree is designed for large enterprises, but PPCP is built for small businesses. And management believes the product extends its addressable market by $750 billion. PayPal stock currently trades at 2.5 times sales. Its cheapest valuation more than 5 years. It creates a very attractive buying opportunity for patient investors. two growth stocks will be worth $2 trillion by 2033. Okay, first Tesla. Okay. Current market cap of $535 billion will need to increase about 3.7 fold over the next decade or 14% annually to reach $2 trillion, but some analysts expect the economy to blow by that figure well before 2033. For instance, our investor believes Tesla will have a market cap between $4.4 trillion and $7.9 trillion by 2027. That may be optimistic, although ARK has been right about Tesla in the past, but that forecast makes $2 trillion look easy. Tesla led industry last year in a battery electric vehicle sales with an 18.2% market share, and management expects to grow deliveries by 50% annually over the long term. Alphabet, got Alphabet and Tesla. What else do we have? AI offers investment opportunities across industries. Companies across industries are using artificial intelligence, and that has people thinking about what AI means for the future of many professions. Alphabet, the parent company of Google, is no stranger to AI. The company uses AI throughout its business, from optimizing its search capabilities to better serving its advertising customers. Recently, Alphabet Chief Executive Officer Sundar Pichai spoke about how AI is set to revolutionize the working world. He even said one industry in particular might be transformed by the technology. And unsurprisingly, Pichai says this may not result in layoffs, but instead more jobs. Pichai AI prediction. The AI may make the law profession better in certain ways and may result in more people actually becoming lawyers. Law firms today already use AI to help draft documents, to verify contracts, and complete other tasks. The idea is AI won't take away lawyers' jobs. Instead, it will help them their stuff do certain things more quickly and give them more time to focus on more complicated parts of the job. I'm willing to almost bet 10 years from now, maybe there are more lawyers. Pichai said that some of the jitters people have about AI today are a lot like the worries they had years ago with the introduction of new technology like computers or the internet. Yet, these technologies may have hurt some jobs, but they've also introduced many new ones and resulting in an overall progression in the employment market. Pichai is doing his part to advance the use of AI. He's made it a focus at Alphabet. For instance, the company uses it to help the Google search engine better understand the meaning of each vocal and written search. Another example, this time in the area of advertising, an AI tool predicts how much advertisers should spend to meet their campaign goals. So the use of AI isn't necessarily about eliminating jobs. It's about improving how we do them. And this makes AI a great new technology to invest in today. Alphabet itself is a solid AI stock to buy, and investors will like the company for other reasons too, such as its giant market share in the search market. Google search holds 92% of that market, and its use of AI may keep that going. Energy transfers. Okay, energy transfers. Mm, Meta Platforms, it's betting on AI technology to power its advertising business. Okay. Mm, and Alphabet. Since its founding in 1998, Alphabet's Google has been go-to platform for people searching for information on the internet. And it has leveraged its niche to create the world's largest digital advertising company. Some investors are now worried that its mode could be soon be eroded by generative AI rivals like ChatGPT, which can fulfill a similar role, but this could be more of an opportunity than a challenge. While it is true that generative AI can do some of the same things as traditional search, Google has some key advantages. AI chatbots simply respond to queries. And unlike search, they do not allow users to interact directly with the internet to find what they are looking for. They do not allow users to interact directly with the internet to find what they're looking for. Further, these platforms must be trained in a huge body of data, which can be outdated or incomplete because third party websites refuse to provide access. For example, Reddit, Twitter, and Stack Overflow no longer allow free access to their data, and other companies could follow suit. On the other hand, as the owner of the world's two most visited website, Alphabet's biggest advantage will be data. The company has a treasure trove of information for training its models, and it is integrating AI into its traditional search business through a platform called Google AI, which embeds its technology into its search results to do things like summarize information. Google also has its own AI chatbot, Bard, which has had some initial hiccups, but this is powerful with the quotes. And it should fulfill a similar role as ChatGPT by answering questions with human-like responses. Mm. Novavax canopy growth, cloud growth. Don't underestimate e-commerce. Okay, Amazon stock price equality up more than 30% so far in 2023, and more gains appear likely. Here's why the cloud and e-commerce juggernaut recent, but bull run is set to continue and perhaps even intensify. AI is set to re-accelerate cloud growth. In the late April, Chief Financial Officer Brian Olszewski said that Amazon Web Services revenue growth has slowed to roughly 11% from 16% in the first quarter. The news drove some investors to sell, uh, though Amazon stock has since recovered its losses. Investors are likely beginning to realize that much of the slowdown in AWS's growth rate is due to recession fears, which are driving many businesses to temporarily temper their technology investments. Yet, even if we do fall into recession, the economy will eventually strengthen, and this intense pressure to cut costs will ease. In the meantime, Amazon is actively working to help its cloud clients reduce their expenses. Management correctly believes that this will strengthen customer loyalty and further cement Amazon's place atop the cloud industry. Moreover, Morgan Stanley analyst Meta Moshe posted that the industry's efforts to optimize customer spending will help expand the overall size of the cloud market by as much as 30% over the long term. In all, Marshall estimated the total cloud computing opportunity at a staggering $18 trillion. After writing off Amazon's sprawling e-commerce empire as simply a loss-making crusade, many investors are starting to rise up to its true profit potential. Okay, let's look at articles about Trupanion. Trupanion has recently, its price has recently gone down a lot, and um, a few days ago, I thought to myself, what's happening with this uh, stock? I mean, it's been keep going down over and over. Uh, and at a certain point, uh, I'm like, is this right? So I'm gonna go search a Trupanion and see what happens with this company. Hmm. Is something bad happening to this company? Huh. Best pet food stocks for animal lovers. Okay, let's read about this in detail. Best pet food stocks for animal lovers. Chewy, Fresh Pet, Petco, Walk. Uh, Trends in the pet industry. Investors interested in pet food stocks should also consider looking into the broader pet industry, including pet medications and veterinary product stocks. Worth considering include IDEX Laboratories, which makes the veterinary diagnostic tools and lab tests, Zoetis, which makes animal health medicines and vaccines. Pet insurance is also a fast-growing sector of the pet industry, and Trupanions offers one way to get pure play exposure to the sector. Trupanion has demonstrated an amazing record of growth. The company is financially healthy enough to maintain that pace, bargain for growth investors. When done right, the growth investing can be very profitable. High quality growth companies will execute on their plans and drive revenue and the stock price higher over time. Trupanion. Okay. Hmm. Hmm. The pet health insurer Trupanion has done that for the last 8 years and continue. This explains how a $10,000 investment stock, when it went public in 2014, would now be worth just shy of $53,000 today, far more than the $22,000 that the same investment over the same time would have yielded from a Nasdaq composite. It doesn't appear as if Trupanion will be running out of steam anytime soon. Let's explore the company's fundamental evaluations. Tripanion's revenue vaulted to 28.7% year over year to $233.8 million for the third quarter. Um, how did the pet insurer accomplish this impressive feat? Total pets enrolled soared 30.4% from the year ago period to over 1.4 million as of September 30. Pets are increasingly becoming accepted as family members. This shouldn't come as a shock. The company's 98.7% average monthly retention rate during the quarter demonstrate that its products are highly valued by customers. While the pet insurer took a net loss per share of making moves build on its track record and impressive top line growth. Pets are increasingly becoming accepted by residents of the United States as members of the family. In fact, 76% of cat owners and 85% of dog owners in the country count their pets as family members. According to the American Veterinary Medical Association, with pets held in such high regard by their human companions, it should be no surprise the idea of health insurance for pets is gaining traction. This is why the market research firm Grandview Research anticipates that the global pet insurance market will grow from $8.3 billion in 2021 to $32.7 billion by 2030. Since its founding in 2000, the Trupanion has grown its total base of enrolled pets to more than 1.4 million. This is how revenue has grown at a 20% annual rate for 60 consecutive quarters. And aside from the promising industry forecast, the Trupanion appears to be making all the right decisions to keep this streak going. The company announced a joint venture last month with Affleck, to provide high-value pet insurance in Japan, combining Affleck's customer base of tens of millions of people with Trippanian's leadership in the industry. His success potential written all over it. Combining Affleck's customer base of tens of millions of people with Trippanian's leadership industry, his success potential written all over it. Once the two companies clear the required regulatory approvals, Affleck Pet Insurance should be up and running in the second half of 2023. Over time, this could add hundreds of thousands or even millions of pets to Trupanian's base. So it's not a surprise that analysts are expecting $1.1 billion in revenue for 2023. For perspective, this would be a 22.2% spike on top of the 901.3 million revenue that is being projected for 2022, a 28.9 growth rate itself. Okay, this is it for today, and I'm gonna see you tomorrow, okay? Bye bye.